Welcome to the third quarter market review and investment forecast. We have a lot to go through today because, well, I'll be honest, there's a lot going on. So before we do so, I want to make sure that you're ready to go. You might want to have a pen, a piece of paper, to write down any important pieces that you want to take from this. At the same time, don't worry, we're recording this. So if you miss something or you want to listen to it again, we can definitely send you one of the recordings. So welcome, I'm Stacy Francis, and today at Francis Financial, we're going to be presenting to you our third quarter market review and investment forecast, not only for the rest of 2018, but also looking forward over the next 5 years. There's a lot going on, and we understand that many individuals are somewhat anxious because we're seeing more volatility in the market than we've seen in quite some time. And don't worry, you're going to walk out of here with the tools you need to plan, grow, and protect your money. And most importantly, to give you the confidence, to give you the comfort and security, knowing that you're on the right track. So let's go ahead and get started because we've got a lot of information to go through. The first section we're going to be talking about is our market review, and we're going to be diving into U.S. stocks. So U.S. stocks, you can see, did quite well. In fact, they outperformed over this last quarter compared to developed international as well as emerging markets. And you can see as you read this, the third quarter is in this lighter teal color. And my favorite color of all time, this dark teal color, is year to date. So that's from January through the end of September. You can see that in the third quarter alone, U.S. large cap did quite well, over 7%. Small company stocks did very well, 3.6%. For the third quarter, a little over 1% for developed international. And emerging markets during our third quarter was just a smidge negative. Now, as you look at this information, you can see that the star performers so far in 2018 have been large company stocks, and they've returned a little over 10% during this time. And the absolute number one winners taking away the biggest medal so far for 2018 is, as you can see, small company stocks. Now, don't worry, we're going to be diving into what is the divergence? Why are we seeing the U.S. market so much stronger than our international markets? And what do you need to do, if anything, to make sure that you're protected? So what's been interesting is that you see this information as of September 30th. Well, to prepare for this presentation today, I wanted to make sure that we included even more information, more recent information, because can I tell you, a lot has happened since September 30th. In fact, after September 30th, we've seen some pretty darn big changes. And with that, you can see that since that date, the S&P 500, representing the 500 largest stocks trading on the U.S. stock market, has dropped down almost 6%, almost 6% in a little over a month, erasing many of the gains that we saw. So as you look at your portfolio, and as you hear people talking about how the S&P 500 did so well, why am I not performing like the S&P 500? Interestingly enough, you'll notice that it has actually not done that well because many of those gains that were really earned during the previous part of the year have been erased. And as of October 11th, the return for the year, instead of that heady 10% number that we were talking about, is closer to a paltry 3%. Now, does that mean that the market isn't going to recover? No, that does not mean that, but we're going to be talking a little bit more about what do we expect over the next couple months. What do we expect over the next couple years? Now, one of the questions that we've also heard from many of our very, very smart and savvy clients is, Well, why are we seeing US stocks do so well compared to our international counterparts? Well, a couple of reasons. Number one, the tax cuts that have been cycling through the US are resulting in higher corporate profits. So they've continued to improve strong profit growth, which has led to, with that strong profit growth, increases in the stock market, increases in the US stock market over time for this last year. So that's great news, but there is a concern, and you may have seen this chart before, maybe not, but let me tell you exactly what this chart tells you. It goes all the way back to September 2008, and it looks on this blue line, it looks at price to earnings, which is essentially what is the price of a stock versus its earnings. This gray line that you can see here is the 10-year average of price to earnings for the S&P 500. So this is the average, and you can see that after 2008, things were trading quite a bit below their price to earnings. So what you could also say, they were trading at somewhat of a discount, a pretty darn good value. Where we are today, you can see that the price to earnings is quite a bit more. In fact, it's 20.2, you see that there, and you can see it's quite a bit heftier, higher than the average. What does this mean? Well, it's a fancy way of saying that large company stocks are relatively expensive, creating a worry, a concern that its expected 5-year returns from US stocks most likely will be lower. Now, what about the other parts of the world? What about the price to earnings ratio for Europe? Well, here we have the UK, France, Switzerland, Germany, and Spain compared to that US price to earnings. So you can see price to earnings 20.2 for United States. You can see for Europe, all of these different countries are significantly less expensive. So it means that overall, a lot of these companies in these countries are under earning relative to their potential and that's essentially showing that they're less expensive than their US stock counterparts. Where else? Well, what about Asia Pacific? Japan, Australia, Hong Kong, Singapore. Australia for me is one of my favorite places. That's where Michael and I went for our honeymoon about 17 years ago. Well, all 4 of these countries that we're talking about, they too are trading much less expensively, many more opportunities to find good value in Asia Pacific. And finally, emerging markets. So China, South Korea, Brazil, South Africa, India, Mexico, Russia. What's interesting, all of these countries too, except India, all of them too are trading at much lower values than the United States. These are all the things that we think about when we're putting together your portfolio. We look at this, we look at a lot of other pieces. So a question you might have as you look at this, wow, if we're trading at such nosebleed levels here in the United States for this S&P 500, are we in for a big market drop? Is the US stock market poised for a big market drop? Well, whether it's a new recession or a recovery, we know that it happens in an economy where is just a natural progression. You have recessions, you have recoveries. But the good news to give you some confidence is that we do not believe that a recession is likely over the near term. Now, when we say the near term, we're talking about anywhere from the next 6 to 12 months. However, we do feel confident that most likely a recession is going to be likely over the next 5-year time period. And in fact, the trade war concerns that we have, unfortunately, only increases the odds. That's part of the reason why with our client portfolios, we are holding less large company US stock than we typically would in an environment with less risk. That's one of the reasons that we are working in this way, and that's to protect. Again, we don't expect a recession in the next 6 to 12 months, but going out, the likelihood of having some type of significant pullback in the next 5 years, well, that's something that we do feel much more confident about. So what do you do? What should you do? What will happen? Will you be okay if there is a pullback? Well, we took a look at all these different times in the market when there were pullbacks. You can see 1987 stock market crash, the dot-com crash, September 11th terrorist attack, and you can see the bankruptcy of Lehman Brothers. This is the 2008. We put this chart together, and what we wanted to show you was the rebound, the amount of, where would your portfolio be if you had stayed invested in the S&P 500 and you hadn't sold? If you were able to stay invested even during these very difficult times, you would have noticed some pretty phenomenal things. First off, you can see that the third year after 2001, you had a 40% return. After 5 years, that went to 81%. So really a very strong recovery. With 2008, we also saw strong recoveries. 1 year later, the portfolio was up 4%. 3 years later, up 12%. And 5 years later, up 47%. So what does this mean? What can you take away from this chart, really focusing on some of the scariest times in stock market history? What you can take away is that if there is a downturn, as long as you have the time horizon to stay invested for at least 5 years, maybe a little longer, you're going to more than make up for that. And you can see in many of these situations, individuals were significantly above where those losses were originally. So that means that you need to make sure you're not going to be like the average investor. The average investor that buys at the top of the market, and then when there's a drop, sells because of fears, worries, anxiety. That's a recipe for losing your wealth over time. Instead, working with an advisor, we find that instead, individuals will sell at the top if they do want to sell. And when things are not going so great, often we use that as an opportunity to buy things that are on sale. And sticking with this plan is a plan that will build your wealth over time. And I don't know about you, but for me, I'm getting ready for holiday shopping. I already started looking at the bargains, doing my research, and bless Samantha, she's already found a few of her presents. She went in and she tore back a little bit of the Amazon box to find that I had gotten her an LOL doll, actually dollhouse, which is her big gift. And at first I was a little bit upset, but then Michael, my husband, reminded me. He said, you are the worst. You are the one who goes to try and find your own presents. Please don't judge me, but he actually is right. I do that. I find my own presents. But what's great about early shopping, even though, at least in my case, my kids try and go and search for them and find them, the great news about that is that often I got a lot of things on sale because I'm not forced. I'm not finding myself at the last minute having to go out and buy a present on Christmas Eve or New Year's Eve. Well, can I tell you, it's the same thing with your portfolio. Being able to have plenty of time, feel comfortable having the right advice from your advisor when there are those dips in the market. Again, it's a great opportunity to buy, just as for me, it's great for me to start holiday shopping early so that I can get some good deals. And it's going to protect you from what I think, which I will tell you pretty much any investment guru will tell you, it will protect you from the biggest investment mistake. And that big investment mistake is pulling your money out of the market after large losses. It's like moving and swerving your car after you've hit a pothole. If you swerve your car before the pothole, that might make a difference, but definitely swerving your car after the pothole doesn't really fix the damage that's already been done to your car. In fact, it could cause a new accident or a problem in the future. So what this analogy is essentially saying is that, you know what? We can swerve to try and not hit the pothole by being smart with the way that we're investing your portfolio. But once we do hit a downturn, that is the worst time to try and make that swerve or make that change. Because by doing that at that situation, you could be finding yourself with a much bigger problem. Selling when the market is down is not ideal because the money is not in the market for those beautiful rebounds that we just talked about a few slides ago. So now the other thing that's on many of your minds are bonds. There's been a lot going on, particularly with interest rates. And I think what's really important for us all to understand about bonds is how do they really work? And we put together this really lovely slide to demonstrate what do bonds do for you. So this is the timeline. So this is a bond that is 1, 2, 3, 4, 5 years long. So at that 5th year, you'll get your money back. And what do you get along the time? You get cash flow, which you might call interest, coupon payments. These are all different things that you can call it. But you're not buying a bond and doing it for free. You're requiring that, yes, I'll get my money back eventually, that last cash flow, but you need to compensate me from now until then. And if it's a very risky bond, well, then I'm going to require you to pay me a little bit more each year until I get my money back. And if it's not as risky, let's say it's what's called investment grade, then you don't have to pay me as much to reward me for holding a less risky bond. So here you can see that the maturity date is in 5 years when the money matures. And then the other thing that you may hear is duration. So what is the average amount of time that you are holding the bond, the average amount of time till you get the majority of your money back? So you can see that that's what duration is here. It's essentially the average of when the bond is first issued and when it needs to be paid back. So this is essentially what a bond is. It is, again, loaning money that you get back at the maturity date, and along the way you get cash flows or interest, something to reimburse you for holding that. So there are different types of bonds here. It's a 5-year bond. This is the maturity date. There are other bonds that are shorter, maybe 1 or 2 years, and longer, 15, 16, 17. This is important to know because the maturity date has a very big impact on how that bond reacts to interest rates rising. And although interest rates did not rise in the third quarter of 2008, there's an increasing possibility of rising interest rates. And so the story for bonds this quarter has been very similar to the story for bonds for the last few quarters, that with interest rates rising, you have to think about how is this going to possibly impact the return rates of bonds themselves. So let me show you what that means. So when interest rates rise, essentially what it means is that the price of your bond falls. And a very good explanation for that is that if you have a bond that's paying out 3%, and a new interest rates rise, so all new bonds that look pretty much exactly the same as yours now are paying out 4%, how does that make your bonds look? Not so good. So it means that your bond price most likely could fall. So how are we taking this into consideration as we're investing our clients' safe money, or we often call it money that we put in the airbag of the portfolio? Well, we have a lot of their money going into what's called short-term bonds, 1 to 5 years. And do you remember that bond we just saw that was a 5-year maturity? That's considered a short-term bond. And it has low sensitivity to interest rates. That essentially means is that price drop that we just talked about is very minimal and sometimes even flat, depending on the situation. Now, what about intermediate term bonds? Well, intermediate term bonds, you're holding it for a longer period of time. You can see 5 to 12 years. That has more of an impact as interest rates go up. So those bonds are going to feel a price drop even more than our shorter term bonds. And what about long-term bonds? Those are those bonds anywhere from a dozen, 12 years to 30. Well, those are the bonds that have the highest sensitivity to interest rates going up. Another way of saying it is those are the bonds that are going to drop in price most significantly. Now, know that price is one piece of the equation, but also remember that these bonds are paying that cash flow each year. So you're still getting interest, right? So that's good. So you don't want to always focus on the price. However, I wanted to show you what we're doing in our portfolios, meaning that in our portfolios, we're receiving that interest every single year, and we are more so putting our money towards short-term bonds because as interest rates go up, short-term bond prices are less impacted. And intermediate, we have some intermediate term bonds too, but we're more so on the shorter term period, the 5 to 6 year, maybe at the most a 7-year maturity. And that too is to protect our clients. Something that you're not going to see, that we are not going to see in your portfolio are those longer term bonds. Because again, the longer term bonds are more sensitive to interest rate changes. And again, we want to have bonds in our portfolios because we want you to receive income. We want to also protect you from big market losses from the S&P 500 or from international stocks. But we don't want to necessarily take on additional risk, especially because we know that as interest rates rise, particularly these long-term bonds, they are going to be a drag on the portfolio. So here's just, again, a really smart look at the portfolio, how we invest them, and what our thoughts are really about that. So let's jump to international stock. The reason why I want to jump to international stock is because there is a lot going on. In fact, this is the year-to-date performance. I'm first going to show you emerging markets. So year-to-date, they've been down about 1%. And I've gone through and we highlighted in red circles all of those countries that are in what's considered emerging markets. What's interesting about this is that there's been a lot of concern specifically about emerging markets. And, concerns about, are these the right place to put our money? We're going to dive really into that very, very significantly over the next couple slides to get a better idea of what do we need to think about, what do we need to look at, particularly with emerging markets and some of the losses that we're seeing. Now, the other area that we show here in this teal green color are developed international. So developed international has done better, up modestly this year. Knock on wood, there's actually been some progress in the international sector versus the beginning of the year. So in the second quarter here, you can see that for international stocks, quite a few of the countries had negative performance, both for developed international that you can see here on the left, and pretty much all emerging markets had negative results here, as you can see on the right. For the third quarter, however, you can see there's been quite a bit of progress. For developed international, we've had quite a few of those countries that posted negative returns in the second quarter. Well, guess what? They posted much better positive returns in the third quarter, which is something we like to see. If you remember that slide that we just looked at, almost all the countries that were designated or defined as emerging markets had negative returns in the second quarter. Guess what? Over half of them posted positive returns. So this is really good. Essentially what we're seeing is that our international holdings are performing much better this last quarter than we saw earlier in the year. So significantly much better news. Looking at emerging markets, as I said, more than half the countries finished with positive returns. And you can see some of these returns. Thailand had a 14% return just for the quarter. Poland, Mexico, Brazil posted a 5% return. Those are very significant returns because remember, a quarter is only 3 months. To post a 5% return in only 3 months is definitely a lot of progress. And I agree that losses are not ideal, but after a second quarter, such a difficult second quarter, we've seen a huge amount of progress, and it really is quite promising. Now, there's a lot of news out there about emerging markets, and boy, something that can really concern you when you think about emerging market stocks. And there are quite a few different factors behind what's going on in the emerging market world. Essentially, the intensifying trade conflict between the United States and China was really one of the bigger movements that impacted negatively emerging market stocks. And it's not necessarily surprising to see a performance divergence between US stocks and emerging market stocks or international stocks. If anything, though, as we look forward, it represents and it shows that there's a lot of opportunity in emerging markets because they're still trading at rock bottom prices compared to the US. One of the reasons that a lot of people don't want to have their money in emerging markets is this, because any of that bad news that you see out there, and actually newspapers and TV programs, they know this, that our human brains have mechanisms that are designed to give priority to bad news. Well, if you think about it, it makes sense. So if you've got a beautiful butterfly to your left and you're looking at your butterfly, and to the right you see a lion charging at you, you give priority to the charging lion, right? Well, all the bad news and scary news that we've seen about the trade war, about emerging markets, developed international, that is much more likely to stay in our brains than the opportunities that long-term are in these areas. So what we try to remind ourselves is that although maintaining exposure to assets that have risk, that may feel comfortable, may feel uncomfortable, it's really important that you have exposure to this area to make sure that you have a diversified portfolio, because we are predicting that you're going to live at least until age 95. In fact, my daughter, most likely, she's now age 9. Samantha is actually probably going to live even to 100. And we need to make sure that the portfolio lasts until age 95. So while it may be uncomfortable, it's necessary to have at least some exposure to US stocks and international stocks so that you have engine in the portfolio to get you through till at least age 95. So we're going to drop into those woes that we saw for emerging markets and dissect them a little bit more. The first was the strong dollar. The second, trade war fears. So a quick question. Did the US dollar strengthen or weaken? Well, interestingly enough, it did a little bit of both. There's been a lot of noise that's been made about the US dollars continuing to appreciate against other world currencies. But it's interesting is that with certain currencies, it actually did strengthen, but other currencies, it actually weakened. That actually is something it's interesting and not many people really look at. But what we're seeing, which is really nice, is that the US dollar has started to stabilize. So this is the US dollar index, and you can see it became weaker through the 70s, spiked up during the 80s in value, and then you can see weaker, spiked up. What's interesting is this time right here in the 80s, that was right about when I was going to France and I was an exchange student. Before you get surprised, I was actually only about, oh boy, I think I was maybe 10 years old. And I went and I remember that a franc, a dollar buying francs, it was something like I could buy 6 francs for every dollar. It was really phenomenal. And then I went back and studied in college, and all of a sudden that $1, instead of buying 6 francs, I would be able to buy like maybe 3.5. Really a big difference. Well, where we are right here is you can see that the dollar increased in value pretty significantly, dropped and then increased, and it looks like we're starting to stable out. So we're starting to essentially be a little bit more stable, which is, in our opinion, particularly for emerging markets, a good thing. So let's go back to the second quarter and see what happened to the US dollar then. Well, the second quarter, essentially every single currency went down in value compared to the US dollar. Another way of saying that the US dollar strengthened against almost every single country that you see here. That creates a very big headwind for international countries and international company profits. So let's look at, flash forward, the third quarter. What's really interesting is that you can see that there were a few currencies where the US dollars did start to strengthen, but there are a few others where the currencies strengthened against the US dollar. So you can see the Canadian dollar became stronger versus the US dollar. The Swedish krona became stronger. You can see the Hong Kong dollar became stronger. And right here in emerging markets, the Mexican peso became stronger. These are also great news because it means that with the increasing strength of these foreign currencies, it is a tailwind. It is just another boost towards more profits coming to us in the investments we make in these countries and in these foreign companies. So let's talk a little bit about how we put that in plain English, because I realize that I'm diving into some pretty big things here. So why do we want to invest in emerging markets? So what we're finding, the tax cuts that we're seeing that are helping U.S. companies post higher profits, lead to a higher stock market, is a good thing. But overall, long term, could cause our fiscal deficit to rise, meaning that this potentially could weaken the US dollar, becoming a big positive for emerging market stocks. Now, with the US dollar expecting to weaken over the medium to long term here, again, it's a benefit for having emerging market stocks. So again, part of that case of why having emerging market stocks in your portfolio is so important. Now, what about increased trade war fears? Well, a lot of individuals are concerned, but I just went to a conference for financial planners. There was about 1,000 fee-only fiduciary independent planners. And we convened in Philadelphia. And when the trade war concerns came up, interestingly, the economists that were speaking talked about it in less concern than most. And that was because they know that overall, a full-fledged trade war is truly unlikely because it's in neither country's interest. And that is something that is, I think, really important to know. But the one thing that this is not going to be a fear or worry that's going to go away. In fact, at least in the short term, we're going to be living in a world with the overhang of trade tensions for quite a while. So again, about that 3-hour economic panel that I listened to, and with the 5 different economists, interestingly enough, only 5 minutes were really spent talking about a trade war, because for them, they see this as a blip. It doesn't mean that we don't protect and prepare for it, which we've done so. We have less exposure to China in our portfolios than maybe some other portfolios. But it's something to know and try to keep in mind that most likely a full-fledged trade war is not going to be occurring. But we do know this. Yes, we know that choppy waters are here to stay, that there's going to be continued political conflict, continued volatility. The market, we do expect it to continue to go up, but also some pullbacks. We also think that interest rates will continue to rise, and that we'll have changes in currency values, as we just talked about. So with these choppy waters, what do you need to think? Well, you want security. And so making sure that you are secure is of paramount importance. Could you imagine how nice it would feel if you didn't have to worry about what happened to the economy, to the stock market, or real estate, that you would have financial security for the rest of your life? Well, you can do that. And that's by having a wonderful, beautiful portfolio that can give you confidence no matter what's going on in the storm and choppy waters of the market. It's an all-weather portfolio that works in rain, snow, heavy rain, overcast. I actually looked up at Stratton, Vermont, where we go skiing over the weekend, because weekends we start typically in late December, going up there and spending some family time just on the mountain, out skiing and hiking and snowshoeing, and it's so beautiful. Well, if you can believe it, they're already going to start blowing snow. So, talk about crazy weather. Just a few weeks ago, it was 80 up there, and now they're blowing snow. It's the same thing. Well, it's the same thing with the market. It feels like it was, pretty darn beautiful in the market not too long ago, and then we had some recent pullback. You want to make sure that you have all-weather portfolio. And how do you do that? Well, you need to focus on the fundamentals, because I wish there was an investment crystal ball that told us what portfolio to invest in and put your money in this investment or that one. But guess what? It really doesn't exist. And the portfolios that do the best over time have a good mixture between high quality bonds, large company stocks, small company stocks, developed international stocks, and emerging markets. This is kind of interesting, talking about the crystal ball. Here at the office, we're doing a fantasy football league here, and I enrolled. And can I tell you, just that is not my forte. Definitely fantasy football, but also it's not most people's forte for predicting investment returns. In fact, predicting investment returns is a fantasy. And here's a really kind of cute cartoon that I found that is investing in a fantasy business league. So It's kind of like gambling with a fantasy football league. Well, some people try to gamble by picking the best stocks and do kind of like a fantasy football league there. They don't call it that. Instead, what they do is they call it essentially day trading, which interestingly enough, I don't know if you've ever looked at the returns on average of day traders versus the people who essentially have a portfolio that's well-rounded and they hold over time. Those people who are the well-rounded hold over time perform those day traders often by more than 50%. So it really doesn't pay. Now, predicting returns is not an easy thing to do. In fact, there's quite a bit of randomness. I get it. This is a really big chart, but we spent a huge amount of time trying to put this together and show you each year, 2008, 9, 10, 11, 12, 13, 14, 15, 16, and 17, what part of the market did the best? And on the opposite end, what part of the market did the worst? And what's interesting as you look at this, the first thing I would say is that you can see very few years did cash ever do the best. In fact, cash is the investment that you can see here in this, lighter blue periwinkle color that for most years is an underperformer. In fact, if not the worst performer. That's important to know because those of you who might be sitting on cash that should be invested for the long term, you're investing in a part of the market that historically has had some of the worst return rates. Good to know. But what about emerging markets? And again, I bring this up because they've been very volatile and a lot of people have had questions. Well, you can see that in 2008, they were the worst performers. But look, had you sold out of your emerging markets in 2008, you would have missed that almost 70% return in 2009. It was also a nice 16% return in 2010, but here we go. The emerging markets then had a tough year, but guess what? They recovered and were first performers. I feel like this is a horse race. Back down, back down, back down, but then look, did really well in 2016 and was the best performer last year. Pretty phenomenal. So if you had overreacted and sold emerging markets in 2008 or 2011, 2015, not only would you have sold at a loss, but you definitely would have missed out on the substantial gains that we saw in the recovery right after. And I get that it's uncomfortable to hold something that has a loss. I get it. And I understand that we trust our guts. It's often natural to trust our gut, to trust our intuition. But I have to say, with investing, often our intuition can cause us to make the wrong decisions. In fact, trusting your gut too much, sometimes we call it overconfidence. And definitely, some investors exhibit overconfidence with the market. In fact, what we find are really smart people. They're very smart, but often they're not necessarily smart about being a solid investment performer, being able to put together a portfolio and stay with it. Now, talking about smart people, the person who comes to mind is Sir Isaac Newton. You don't get too much more intelligent than Sir Isaac Newton. Well, he has a really interesting experience that I wanted to share with you. He was one of the early adopters, the early owners of what's called South Seas stock. And so back in the spring of 1720, right there, 1720, he went and he invested a bit in the South Seas Company. It was truly the hottest stock in all of England. But sensing that the market was starting to get a little out of hand, he decided that he was going to essentially get out before the stock plummeted. Now, what's interesting, he didn't do bad. He increased his shares. It was about 100% return that he had. But Interestingly enough, just a few months later, you can see what happened. There was a huge euphoria, a wild enthusiasm in the market. And well, Newton was pretty upset. He jumped in again and he put in his money at a much higher value. So he jumped right back in and held it. Held it because he didn't want to miss out on this new euphoria. Well, interestingly enough, he then exited after putting his money in at such high levels. He came out and exited broke. He lost more than 20,000 pounds, which may not seem like a lot to you, but back in that time, it was about $3 million if you were to put it in today's dollars. So for the rest of his life, he actually forbade anyone from ever speaking the word South Sea in his presence. Didn't matter if they weren't talking about the stock, even if they were just talking about South Sea. So what's really interesting, this very smart gentleman, Sir Isaac Newton, he said, I can calculate the motion of heavenly bodies, but not the madness of people. Well, really what he was saying is, guess what, guys? I'm really smart. Everyone else is stupid. And it's really not my fault that I lost the money with South Sea's stock. Everyone else caused the stock to go down. So here is an example of sometimes overconfidence of trying to trust our gut, and our intuition tells us the wrong thing with the markets. Another really interesting thing was the Buffett bet. And the Buffett bet was essentially Warren Buffett saying that he would bet $1 million that the S&P 500 would outperform a collection of hedge funds over a 10-year period. So who won? Was it Warren Buffett or was it the hedge fund managers? What do you think? Well, it was Buffett. He won. And actually, interestingly enough, over the course of the bet, the S&P 500 index returned almost over 7% annually. It was significantly more than the hedge funds. So how did just investing in the S&P 500 index trounce hedge funds that were being actively managed and really picking ideal investments versus just investing in a pool? Well, the Buffett bet and him winning with the S&P 500 really shows that there is an overconfidence bias, that the typical person often believes that they can outperform the market. And it really doesn't pay. It also proves that hedge funds, their speculation, their high fees, investing in this piece and not that one, typically do not work. So what should you do? If you can't necessarily trust your gut, what you can do is focus on what you can control. Let the markets work for you. Outperforming is typically a loser's game. Invest in a tax-efficient way. Invest in the lowest possible way, and diversify. Stay disciplined. I had a private tour of Vanguard over the weekend. Really fantastic. They love to work with fee-only financial advisors. I love some of their products because they are low cost efficient. They're cost efficient, they're diversified. They let the markets work for us. So in this, it was just kind of like a meeting of the minds. And they believe that, again, people do not typically outperform the market long term. The way that we know our clients should invest is by using an emotion-free, proven investment formula. It gives our clients confidence. We know that we can invest confidently, knowing that each investment decision that we make is rooted in academic research. We have many different research resources, and the two of the Nobel laureates out of the Chicago Booth of Business are part of our research that we look into, and their information, their evidence-based information and research is really important, because as you know, that your investment portfolio, it's the foundation. It's the foundation for your financial security. It's the foundation for your long-term growth. And so when times get scary, because they do, know that the longer you stay invested, the smaller the chance you have of losing in the market. So don't do what I call an Isaac Newton. Just don't do it. Invest for the long haul. Don't try and time the market. Isaac Newton can't do it. Hedge funds managers can't do it. And can I tell you that the best people, the way that they grow wealth over time is by investing in wealth and investing in a portfolio and staying with it. So how do you deal with risk? Risk can be scary. Risk can hold us back from making good decisions. And this was a really interesting study that was done. And 100 people were given the option of either getting $700 or they had an 80% chance of getting $300 more, of getting $1,000. Well, what's interesting is that most people chose the $700. Why? Because there was no risk of doing that. However, this 80% chance of getting $1,000, the average person who picked this walked away with a lot more. In fact, you had an average, the average return on that was $800. So what this tells us is that risk makes us sometimes choose decisions that feel safer. So because there's a little bit of risk in this 80% chance of getting $100, instead of getting that $1,000, we saw most people just going straight for the bargain and the for sure thing, the $700. Cramer. So I don't know if you've ever watched Mad Money, but I would tell you not to. But there are lots of charts, lights, flashes, animal sounds, sirens, focusing on the short term. No one's challenging Jim. Often he has a lot of overconfidence. He's a fast talker. Everything's in a shade of red. So essentially, he preys on risk, on telling you that if you don't do this, something might happen. If you don't invest in this, then you risk FOMO, essentially that fear of missing out. I just learned that from one of our millennial advisors here. I had no idea what FOMO meant. Well, FOMO means fear of missing out. So number one, if you don't do this, you could lose money. And number two, if you don't buy this stock, you could have the fear of missing out. The challenge with having and exposing yourself to these types of programs is that it creates a lot of anxiety. In fact, experts on investor psychology cite him as a guy that is most likely to push our emotional buttons, the person who's most likely for us to make impulsive decisions. There's a really interesting book called Where Are the Customers' Yachts? It was actually wrote back in the 40s. And essentially what this book says, which is something that I really wholeheartedly believe, is that speculation is an effort. So choosing this stock over that stock, probably unsuccessful to turn a little money into a lot. Whereas investing is an effort which should be used to prevent a lot of money from becoming a little. So even back in the 40s, they knew that long-term investing was the right way to grow your wealth. So we're coming up to the end here, and I think what the most important thing is, how do you protect yourself? How do you ease your anxiety? How do we worry less? Well, having a plan in place will definitely ease anxiety. When you have that gut reaction, go back to the investment policy statement that we create for you. Go back to that financial plan. Reach out to us to give you that confidence, that extra hug to know and feel comfortable that you're on the right track. And knowledge also will ease anxiety. And we looked up some of what we think are some of the smartest books for investors. The one that I just talked about, Where Are the Customer's Yacht? Misbehaving, which is the making of behavioral economics, all about how we invest and everything that goes into that thinking fast and slow, which I actually have. I have that right on my my desk there to read. And The Invisible Gorilla, how our intuition can deceive us. So some really, I think, interesting reading to help you feel more confident about your knowledge and help you make yourself a smart investor. And I think the thing that will ease your anxiety even more so is that you're okay now. In fact, you are okay now. And the way that we've created the portfolios and the tweaks that we continue to make along the way put you in that situation where you know that no matter what type of day in the market it is, that you're on track for the long term. So if you are concerned and you're not currently a Francis Financial client, we'd love to talk to you. We have a second opinion service, and 80% of successful individuals would value a second opinion. That's 80%. That's according to the Wall Street Journal. So if you want a personalized review of your situation at no cost, please do reach out to us. We offer this for clients or potential clients that have a portfolio of $1 million or more, which is our minimum to work with Francis Financial. Please email us and reach out to our award-winning team. We've received awards from CNBC, from the Women's Choice Award, pro bono awards for our efforts with Savvy Ladies, giving away free financial education to over 20,000 women. We are fee-only fiduciaries through NAPFA. We are also recipients of the Wealth and Money Management Award. Medical Economics announced us as a premier place for those studying for a medical degree to have personal financial planning and investment management. And the one that I'm very proud of and most recent is the Top Wealth Advisor Moms, nominated by Working Mother magazines. We are moms, and we work with a lot of moms. And I have to tell you, moms, families, kids, we all need financial plans to make sure that we're going in the right direction. So reach out to us and our award-winning team. We'd love to work with you or anyone that you care about that you think could benefit from having a roadmap, from having a wonderful diversified investment plan, of not having to worry about money anymore. So call us, email us with your questions. It's info@francisfinancial.com, or you can reach out to the office, 212-374-9008. And you also can go to our website, www.francisfinancial.com. We're at the top of the hour, ending right on time. Thank you for spending some time with us. If you have any questions, again, please reach out to us. I'm giving you a big hug and have a great day.